In January, RIN TV began broadcasting daily reports covering the news and information important to the global insurance community. Our audience grew substantially throughout the quarter as a result, as the industry embraced online video news. In fact, each month set a new RIN TV record for viewership. With Q1 now behind us, we look back at the top stories that made headlines on world risk and insurance news through March 2013.
Over the past 5 years, the insurance industry has faced a confluence of challenges, including a global recession and financial market meltdown, near record cat losses, a zero interest rate environment, a federal government bullseye on our backs, and a convergence of international regulators seeking to impose one-size-fits-all global banking standards.
Overall, Munich Re recorded 900 natural disasters worldwide, well above the 10-year average. Insured losses are at 65 billion US dollars, the third costliest year for the insurance industry worldwide.
There are going to be a number of big issues in 2013. Catastrophe losses always loom large. As we ended 2012 with Hurricane Sandy, we're going to find out in 2013 what Sandy ultimately cost.
While the insurance industry has been roundly praised by officials like New Jersey Governor Christie for their handling claims from Hurricane Sandy, the U.S. government and now banks have been criticized for their slow response.
We said going in that the preliminary estimate of $11 billion was based on what companies knew at the time. And as we've said in the past with other catastrophes, we need to wait for insurance companies to get out and make their inspections, make their coverage decisions, try and separate the damages caused by wind versus water, storm surge versus windstorm. So these things have been taking place.
It's interesting when you look at 2011 and the economic loss from natural catastrophes was in excess of 400 billion. The insured losses were around about 100 billion. So someone's got to pick up that gap. At the moment it's government that's picking it up. Surely that's an opportunity for our industry to go out there and offer products that actually satisfy demand and help these people and these businesses manage that risk.
That is us becoming less relevant. That's more and more economic activity, more complexity of risk, and the companies that create that opportunity and risk saying they don't need us or find us useful. And I don't think there is a greater crisis in the industry than the crisis of creativity and innovation.
As a new product expert, I love legislation. There is nothing like Congress passing new liability to prompt the insurance industry.
One idea getting a lot of attention, gun owner insurance. Lawmakers believe insurance premiums could be a financial incentive for safer gun ownership as car insurance companies reward safe driving.
And at any time in the future, Medicare can come back against the employer or the self-insured employer or the insurance company if it's a guaranteed cost program for any treatment related to those initial ICD-9 claims, and there is no statute of limitations on that.
In a clash of cultures, a recent lawsuit filed in Los Angeles pits Lady Gaga against Lloyd's of London. Concert promoters for the pop star say 3 Lloyd's syndicates refused to pay a claim on a terrorism policy taken out on the Born This Way Ball tour after a concert in Indonesia was canceled.
State-based regulation is best for the United States, and we don't need to have the imposition of a federal regulatory system to be able to deal at the global level.
So regulation, when appropriately done, can be a value added both to the industry as well as to the customer base. Customers like to know that there are set rules. And believe it or not, the insurance industry likes to know when there are set rules.
What the Geneva Association did in early December was publish actual facts. It basically shows that the insurance companies are not in the same zip code of systemic risk that the banks are. You really need to look at the underlying facts. Facts and evidence should drive policy. It's often said that when a bank fails, it has a heart attack. It fails of a heart attack, and an insurance company, it's a disease that takes a long time.
In most organizations, having someone provide those traditional risk management elements like risk financing, loss control, claims management are absolutely essential. Those risk professionals that are looking for more and how they can create additional value in their organizations to become more strategic.
The most unique challenges facing risk managers in the energy sector today are the technology changes. as well as the advent and proliferation of hydraulic fracturing.
Classically, we think of cyber insurance as, first of all, third-party liability, and then secondly, the cost of responding to the loss of that data, breach response coverage, we call it. It can also cover loss of data in terms of its first-party value, business interruption losses, websites being down, for example, cyber extortion, crisis management costs.
Recently, the World Bank announced a 2-year pilot to see whether catastrophe insurance might work for Pacific Island nations. The Pacific Catastrophe Risk Insurance Pilot was organized by Japan, the World Bank, and the Secretariat of the Pacific Community, and will involve 5 Pacific nations.
It looks like by the mid part of 2013, the key economies in Europe should begin to recover, including the UK and some of the Western European nations on the continent, and hopefully some recovery in Asia as well, particularly in China. And with all of that, we should begin to experience, I think, what begins to seem like normal in the global economy for the first time in about 5 or 6 years.
If you'd like to view the fully edited reports featured in our first quarterly review, you'll find them in our on-demand library.